One of Wall Street's worst-kept secrets may not be a secret anymore. After Chinese media reported on the matter earlier, the Wall Street Journal confirmed that fast fashion retail giant Shein has secretly filed for its long-awaited IPO. Most investors had expected Shein to make the move this year due to recent activities that could only be interpreted as it preparing for its IPO. Investors were tipped off by Shein's efforts to change perceptions about its business practices by publicly addressing a range of criticisms from consumers and politicians this year. Until now, the company had been pretty tight-lipped, so this openness raised a few eyebrows. Despite this, some investors may be wary of Shein due to the potential for the CCP to impact its business. After all, Shein is mainly dependent on its Chinese suppliers. Now, we've all seen how the CCP can impact Chinese stocks following the Chinese government's crackdown on the tech sector. Alibaba was the first to be impacted by the CCP when the Chinese government started a probe into Alibaba allegedly abusing its market dominance. Eventually, Alibaba was slapped with a $2.8 billion fine. Overall, Alibaba's stock is down 70% since the Chinese government launched its investigation. But it wasn't only Alibaba that the CCP impacted. In fact, what happened to Alibaba was part of the Chinese government's tech crackdown to assert dominance over those companies. For instance, Chinese tech ride-sharing company Didi was also impacted by the CCP when it challenged its authority and went through with its New York Stock Exchange listing. You know what happens next. Didi challenging the CCP's authority didn't bode well with it. So the Chinese government launched an investigation that prevented Didi from registering new users. The worst part is that the investigation started just a few days after Didi's IPO. Needless to say, Didi tanked on the news and was down 57% from its IPO price on the day its shares were delisted from the New York Stock Exchange. You might think that the same could happen to Shein when it IPOs. However, Shein made a very smart move. Shein moved its headquarters to Singapore. At the same time, it deregistered its original company in China in 2021. But still, since Shein is dependent on Chinese suppliers, it still may not be very immune to the CCP's shenanigans. So knowing all of this, will Shein's IPO be successful? Or will the many controversies Shein is in will tank its stock once it's listed in the US? Let's find out. Welcome back to PST Markets, where we provide daily stock market updates. Today, we're taking a deep dive into Shein's IPO plans, the controversies surrounding Shein's business, and most importantly, whether it's a good investment or not. Now, let's dig in. Shein was founded in China in 2008 by Chris Xu. At the time, Shein had no involvement in the design or production of the clothes it sold. It was basically a drop-shipping company that sold items from third-party wholesalers directly to customers all over the world. But that changed in 2012. At the time, Shein launched its current website and started using social media marketing by collaborating with fashion bloggers for giveaways and advertising items on Facebook, Instagram, and Pinterest. Shein also started to establish its own supply chain system. And in 2014, Shein acquired Romwe, which is a Chinese e-commerce retailer. So Shein was no longer a drop-shipping company, but it became a fully integrated retailer. So in 2016, Shein had a team of 800 designers and prototype makers to manufacture Shein-branded clothes. And by 2019, Shein's clothes were featured on daytime TV shows in the US, as well as online businesses like Fashion Nova and Zaful. So how did Shein rise to prominence in such a short time? Easy. You see, Shein's success is attributed to its successful marketing efforts. Shein is known for its dirt-cheap clothes. Even if its clothes are low quality, people still buy them due to their very low prices. After all, Shein is known for selling $5 skirts and $9 jeans. As a result, it became very popular among Gen Z customers who prefer buying less expensive clothes. So to get more customers from this segment, Shein focused all of its marketing efforts on what they constantly use. You guessed it, social media. Shein was an early adopter of TikTok as a promotional tool. Remember that TikTok trend of influencers bulk buying clothes from Shein and presenting them to their audiences like normal haul videos? That played a large role in driving customers to Shein's website. This is probably why Shein's app downloads surpassed those of Amazon in 2021, becoming the second most popular shopping app in the world in the process before becoming the most downloaded app in 2022. But that doesn't necessarily result in more sales, right? Sometimes we just look at stuff and end up not buying them. But Shein has many ways to stimulate demand. First is its very low prices. That alone is an incentive for many customers actually to buy clothes from Shein. But it's not only cheap prices that Shein uses to stimulate demand. Shein also rewards customers for their spending, as with more spending, they can be rewarded with more discounts that can be applied to their next shopping trip. But that's still not it. Shein's advantage comes from its use of AI to identify trends and then leverage its factories to pump out cheap clothes before any of its other fast fashion competitors even know what's going on. For instance, if Taylor Swift is wearing a brand new dress that fans totally adore and start searching for on the Shein app, Shein can easily produce a cheap version of the same dress in less than a couple of weeks. As apparently the only player in fashion to be this successful at combining tech, manufacturing, and making cheap appealing clothes all at the same time, Shein has a very compelling moat, and the results speak for themselves. Shein has an almost 50% market share in the US fast fashion market, and its shares are still growing in other places in the world. That's why Shein was able to generate $24 billion in revenue and $800 million in net profit in 2022, which is almost as large as more established retailers like Zara and H&M. This was then followed by record revenue and income for the first 3 quarters of 2023, as reported by the Wall Street Journal. So after this huge success in the fast fashion market, Shein is now branching out into selling things as a competitor to the likes of Amazon. And this is where Shein's business model gives it an outstanding competitive edge. Shein deals with the manufacturers directly. So with Shein, it's the manufacturer to Shein to the customer. Meanwhile, Amazon is the manufacturer to a third party and Amazon to the customer. So by eliminating the third party from the whole process, Shein has pricing power. But this also comes with its own risks, as Shein assumes the risk when negotiating very low prices at large quantities and marking up the products at whatever price it wants. Now, Shein's business goal is to accumulate customers and maintain its reputation of being the cheapest online retailer through social media and selling dirt cheap products. As such, it has the potential to be a strong force in Amazon's home turf, the US, with its popularity among Gen Z customers and dirt cheap products. So, like all successful private companies, Shein now wants to become public, and it's already working with Goldman Sachs, JP Morgan Chase, and Morgan Stanley as underwriters on its highly anticipated IPO. And according to sources from the Wall Street Journal, Shein's IPO could happen as soon as 2024. Last year, Shein was valued at $100 billion in a fundraising round, but that value was reported to have dropped to between $50 and $60 billion this year due to higher interest rates and an uncertain market. However, we know that earlier this month, people familiar with Shein's IPO plans told Bloomberg that it hopes to get a valuation between $80 and $90 billion, which would make it one of the largest IPOs ever. And after the latest CPI print, the stock market has been rejuvenated. Much anticipated IPOs like Klaviyo and ARM were bad performers until the CPI print, as both dropped by as much as 18.8% and 8.8% respectively. But since then, both stocks have been on a completely different trajectory, with Klaviyo and ARM above their IPO prices. And this brings hope that the IPO market will rebound in 2024. So will Shein have a successful IPO, or will it tank once it makes its debut? Looking at Shein's investor base, there's a big chance its IPO will be a success. One of Shein's largest investors is the Chinese arm of reputable venture capital firm Sequoia Capital. Sequoia has made itself a name for investing in promising private companies that have had successful IPOs over the past 51 years. And with $85 billion in assets under management, investors appear to have confidence in Sequoia's investments. Sequoia's investments include early bets on several unicorns as follows. Apple IPO'd at $22 in 1980 and is currently at $190 after splitting 5 times. So on a split-adjusted basis, Apple's IPO price was only 1 cent. Cisco IPO'd at $18 in 1990s and is currently at almost $48 after 4 stock splits, meaning that Cisco's split-adjusted IPO price was 4 cents. Google IPO'd at $85 in 2004 for a valuation of $23 billion. Now, Google is a $1 trillion company. Nvidia IPO'd in 1999 at a valuation of $625 million, and it has swelled to more than $1 trillion right now. Airbnb IPO'd at $68 in 2020 and is currently at $127. Palo Alto Networks IPO'd in 2012 at a valuation of $2.8 billion and is now valued at nearly $88 billion. Snowflake IPO'd in 2020 at $120 and is currently at almost $172. So Snowflake could be considered disappointing compared to Sequoia's other investments, but it still provided investors with a sturdy 47.5% gain from its IPO price. Some say that these companies are American, so the results may not be the same with Shein. Sequoia has had several successful Chinese investments. In fact, Sequoia was the most prominent venture capital investor in internet giant Alibaba. Alibaba went public in 2014 at $68 per share, and then went on to reach a peak of $320 in late 2020. However, Alibaba's stock lost most of its gains following China's tech crackdown and is currently at $76, but still higher than its IPO price. So overall, Sequoia has a solid track record in backing successful IPOs, and since Sequoia is one of Shein's largest backers, it's very likely Shein's IPO will be another Sequoia success story. After all, Shein has a very attractive moat, and its business model has proven to be successful, as seen by its record revenues and profits. This brings us to the end of today's video. If you enjoyed this video, don't forget to leave a like and subscribe to our channel to get more videos like this one. Your support means everything to me. And tell me what you think about Shein's IPO plans in the comments below. Will Shein be another Sequoia success story, or will its connection to China prove to be too big of a risk for investors? Let me know in the comments below. I read all of them. If you're watching till now, thank you, and see you in another video soon.